Good morning, ladies and gentlemen, and welcome to the HOSTMORE PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question at any time and press send. The company may not be in a position to answer every question received during today's meeting. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we would like to submit the following poll, and I'm sure the company would be most grateful for your participation. And I'd now like to hand over to Robert Cook, CEO. Good morning, sir.
Good morning, and thank you for joining our interim results presentation. And if I could just go straight to page 3, if I may. So just to give you a little bit of a background of who we are and who HOSTMORE is. We're a UK hospitality business established in 2021 as a result of a demerger from Electra Capital, and we entered the stock exchange on November the 2nd of last year. We operate a unique collection of hospitality brands with significant long-term growth potential. We're a highly experienced management team with a strong track record across the hospitality and leisure sectors as a whole. And our customer proposition is underpinned by a strategic investment to improve the quality, simplifying the menu, and offering the focus on the brand and on brand relevance. And this came from market research that we did at the end of 19 going into 2020 about what the consumer thought of our main brand, which was at the time TGI Fridays, now better known as Fridays. Within our portfolio, we have 3 brands: the Fridays brand itself, 63rd and First, which is our cocktail-led bar proposition, and Fridays and Go, which is our first foray, taking the Fridays brand into a QSR environment. We'll go to the next page, please. We're a large and growing estate across the UK, where we have 90 sites, and you'll see from the map on the right-hand side, we have got geographic distribution with 13% of our total business in Scotland, right down to the south coast and southeast, where we have Bournemouth and Brighton right on the south coast. And the percentages show the spread that we have throughout the UK, which we feel is a strong place to start from, but there is obviously a lot of white space yet to fill, and therefore gives us lots of growth opportunity. If I move on to page 5, most of which are in describing our properties in high footfall locations. We have 34% in retail park, 31% in shopping centre, 19% in growing in city centre due to 63rd and First. Standalone, our legacy sites that when Fridays first came to the UK some 35 years ago, in drive-to locations where we have our own car parking, and also in stadium venues now, which is 3% of our total portfolio. Our portfolio in more detail, we have 85 casual dining restaurants under the Fridays banner in the UK and 1 in Jersey. We have 1 Fridays and Go, which is a trial site for us, a quick service restaurant in Dundee on the High Street. We have 4 63rd and First, our cocktail-led restaurant and bar in Cobham, Harrogate, Glasgow, and most recently opened just at the beginning of the festival in Edinburgh. And as a business, we employ 4,442 people across the business and across the UK at the moment. Our half-year 22 highlights, as I described in my quote, stable performance despite the macroeconomic headwinds. We've seen 145% like-for-like revenue increase. 145% versus half 21 last year, down 7% compared to pre-COVID-19. Like-for-like revenue is in line with expectations. We've seen 17.8% EBITDA, adjusted EBITDA, adjusted free cash flow of 10.1 million, and we've reduced our debt from half year 21 from 28.6 to 26.2 million. With 3 new store openings, so we've opened 3 new stores this year thus far, showing good organic growth, and the creation, in particular, Fridays and Go, our first foray globally into QSR, our new casual dining brand. Pleasingly, our NPS is up by 87% between June and September 22 due to improved customer experience based around value and quality of food execution, which was all part of the work that we did around the 3 staples of simplification and quality and relevance. and the 12-month extension of our banking facility to the 1st of October 24 with an RCF of now 30 million, an increase from 25 million in the past, and Alan can describe the RCF in more detail. Operational developments, we've seen the 3 new stores, a Fridays open in Chelmsford, a Dundee Fridays and Go, and the post-period end Edinburgh 63rd and 1st, with 2 more sites opening at the end of this year for Fridays. Improved customer position and proposition and experience reflected in elevated guest satisfaction scores and a very pleasing result. We've invested and attracted a new CMO to evolve our digital transformation at speed and define that singular customer view using data to make all our decisions for us on the go forward. Rhiannon Scarlett was appointed from the Body Shop, and previous to that was a long-term servant of Dumbhumby, where she looked after the Tesco account. So then with that, her enhanced marketing activity to broaden customer appeal and expand audience through a data-led reach, and new campaigns to be launched in H2 of this year, and in fact in October. We also further enhanced our operational team with a new operational head, a new CEO, to improve operational standards and efficiencies. Julie McEwen was appointed in February of this year from the Big Table Group, and she's a renowned casual dining operator and doing some great work for us, of which we will see the fruits of that labour coming to pass in the next and coming months. Significant progress in developing our ESG strategy, and I'll go on to talk about our own green mission later in the presentation. We're still an appealing brand from an employer point of view, high levels of interest in joining our brands. We've had over 22,000 applications for hourly roles in the 12 weeks to the 15th of September. And then lastly, digital initiatives are well underway. The CRM project that I mentioned earlier in our last presentation is now embedded, and we're now trialling electronic point of sale is in place in 3 of our 4, 63rd and 1st, and about to start a trial in our new Barnsley store for a new POS for Fridays. Just some photography here to show our operational developments. So our new store in Edinburgh, 63rd and 1st, and our Fridays and Go in Dundee are shown on page 10. On page 11, we here describe the 5.2 million main courses served during the period, which is 200,000 customers per week through the business in June and July. And again, reiterating the guest satisfaction score, an increase in NPS by 87% through the period of June to September in 2022. During this difficult time, however, we've had to mitigate some headwinds, and we believe these actions will assist in mitigating the lower volumes and anticipated and lower revenues that will come with that over the second half of the full year 22. Operational efficiencies such as monitoring food wastage and minimising transport costs with the existing and long-serving supply chain are underway. We're re-engineering menu recipes without compromising on quality or our Americana genre and our heritage of our brand. An introduction of appropriate and targeted price adjustments, which Alan will go into in some detail as he takes you through the remainder of the presentation. Managing rising costs, we've seen a 2.4 million of rent concessions secured from landlords in half 22, aggregate value secured since September 20 of £10 million of rent concessions as a result of COVID. We have managed to secure further hedging of gas and electricity, and whilst we have just received this morning the government's news on its plans for energy, we have hedged our gas and electricity pretty successfully to the end of this year and into the beginning of next. Notwithstanding that, and not having been through the detail quite yet, we think there are still some benefits from the government's offer. Limited food and beverage cost increases by leveraging supplier partnerships and hedging have also been managing our rising costs. And then measured targeted investment, enhancing marketing to increase market share in a difficult consumer environment, the investment in a new marketing lead and team, digital search and also digital reach and also social reach targeted to locale rather than just a blanket approach, and continued investment in training and development across our employee base to increase retention, particularly on the onboarding of new team. We've seen not only in our business but across the industry that post 90-day onboarding, if you get people to stay past 90 days, you have a stickier employee, which obviously helps ongoing recruitment costs. At that point, I'll pass over to Alan to take you through some of the financial headlines of the year.
Thank you, Robert. So on the results summary, what we probably want to highlight is a snapshot in terms of the performance relative to half year 21. We're pleased with the progress that's been made, but we're obviously very sensitive to the fact that there will be some challenges as we go forward in the next 69 months. Firstly, the total revenue. We highlighted on the left the fact that this is obviously a different portrayal of revenue, whereby we move back to more normalized circumstances compared to the pandemic restrictions of the past year. This year was affected by Scotland's social distancing, which carried through Q1 period, and then obviously the change in the output VAT rate, which moved back to 20% from 12.5% from the 1st of April this year, which would have had a benefit for us. In terms of the group adjusted EBITDA, and I will go into this in a little bit more detail further on, we're sort of pleasantly pleased with the fact that we've maintained the margins compared to the prior year, but whilst respecting the fact that they are two very different periods. The group loss before tax, what we want to highlight there is the fact that we have impaired assets, which is undertaken as part of a review every 6 months. Obviously, with the trading for the first 6 months of this year and with predictions going forward in the short term, we have recognised an impairment of assets. We are hopeful, though, as time goes by, that as the stores improve their trading results and post the recessionary period, we would expect this book entry to reverse in time. So there's a non-cash entry that's purely a book entry. And then finally, at the bottom of the page, just to flag the adjusted free cash flow. What we have had in the first half of this year is the settlement of a number of legacy or substantial costs which were incurred in prior periods. And I've highlighted some of the more significant amounts there, the largest being the accrued listing costs, where we've settled the 6.8 million of the total costs of the DPD merger during the first part of this year. In terms of the revenues and like-for-like performance, the revenues as presented, the like-for-like to highlight, we are 7% down for the first half of this year against FY19. This is pretty much in line with the expectation and what we had indicated previously towards the end of May and thereafter. So we're pleased that we've sort of maintained and possibly slightly improved on that. In terms of and similarly, I guess the guidance that we'll have going forward, we will share it later on in this page. A little bit of colour in terms of the revenues. The stadiums and city centre, we've identified off the earlier graph or graphic that Robert had shared as being the two areas most affected compared to the FY19 periods. Stadiums are very much events-led, so as those calendars start to be built out again, we see those stores as coming back and doing substantially better again. City centres, the concept of the work from home is still evident, particularly noticeable in London, where sort of the Mondays and Fridays are generally quieter than what they've been traditionally. So that sort of recognises that. The southeast and the northwest tend to be the more general sort of geographic areas where it's most impacted. And this is pretty much where we have the bulk of the stadiums and city centre stores. Dine out remains part of our business, and Robert will go into that in a little bit more detail later on, but it has edged up slightly, but it is still a relatively small part of our business at about 5% of revenues at this stage. This graphic really tries to set out the comparison in terms of the 2 half years. So on the left-hand side, you can see what the reported result was in the prior year, and then moving from left to right across the page, you can see the significant impact that last year benefited from in terms of VAT and or business grants, which were awarded to the sector. The third bar is the obviously significant impact of the increased revenues and how that is actually converted. What I'd like to flag here, sort of on the bottom right-hand side, I have the bullet comment where I make reference to store operating margin, PACE as we call it, which is the profit after controllable expenses, which is effectively sales less the variable expenses, and an effective measure of efficiency. And I'm quite pleased to see that that has remained sort of at the 36% level, which is very much comparable to FY19. So where costs are within our gift to manage, we have definitely undertaken that. As we move further across the page in terms of the bar chart, cost of sales, That has had a slight negative impact through the course of the half year. There's a reason for that, in as much as we have deferred price increases as much as we possibly could. So our first material price increase that was actually introduced into the business actually came through towards the end of June, which is just prior to the reporting period. Direct payroll and direct operating costs. This is really the drivers for the efficiency. As the business has got busier again, you can see that these areas we've been able to better manage, and that's resulted in them making a substantial contribution to the overall margins compared to FY19. Inflation at this stage remains sort of around about the circa 10%, which is pretty much in line with what we had previously indicated as well. In terms of cash flow, from on the table towards the right, you can see cash flow from operating activities has been strong, much stronger than half year 21, which is very pleasing. The movements in working capital, negative at £10.5 million, very much anticipated, and I had highlighted previously as to the reasons therefore, and which was the settlement of the arrears costs for demerger and rent obligations. We have reinvested back into the stores. We've obviously opened 3 new stores, which is the Dundee, Chelmsford and Edinburgh stores, but equally we've also doubled the investment into the maintenance of the estate. So that's gone from about £800,000 for half year 21 to 1.6 million in the current period. And that's really to make sure that the stores are in a good position to benefit from when we start to get busier again. The financing is materially made up of 2 key drivers. We did undertake further term debt settlements, really through the measure of the RCF, which has been provided to us now. And there we made a payment out of what we term short-term surplus cash of £5 million. And equally, what's also affecting that number is as we move back towards quarterly in advance rent payments, at present we pay a number of our landlords up until the end of last month and up until the end of December, monthly in advance, but that will be reverting back to quarterly in advance now. Practically, as we go forward, the intention is that cash holdings will be sort of at the region of sort of 10 million or slightly below that. And this is trying to maximize the opportunity to reduce bank debt financing costs. In terms of net debt and liquidity, from the table, you can actually see the reference to the further payments that have been made against the RCF. So the 7 million is made up of the 5 million against the RCF and 2 million of contracted amortization. So whilst the gross bank debt is significantly down on half year 21, which I think is a very good position, that has had an impact in terms of the overall cash holdings for the reasons that are provided, which is based on better treasury management. The lease liabilities reflected, they show a slight decrease on half year 21. But what I am pleased to point out here is that we have contracted with a small group of landlords for the extension of leases on particularly profitable stores. So thereby ensuring that the future of the business is secure by having those profitable stores as part of the estate. To highlight then also the bank facility was extended by 12 months at no cost associated thereto, which we see as a vote of confidence from our lending banks. And at this moment in time, we have an undrawn, of the £30 million RCF, we have £27.5 million, which is undrawn, and are currently sort of sitting with just under £13 million sitting in the bank as well. The sum of the 2 parts being very important as we move forward through sort of the remainder of the recessionary time to give us confidence that we'll be able to maintain security over the business. For purposes of guidance, starting with the revenues, what we have indicated here is that whilst when this presentation was done, and we've obviously had the benefit of some indication from government of support for the consumer, nothing was necessary or nothing was clear as to how that might actually have benefits or translate further into revenues. So consumer demand, we are expecting still to be challenged, and the view is that this is mostly in the October and November periods, and then possibly through into the January and February. We do have a view that the December month will trade well. Last year it traded well regardless of the Omicron, so we are optimistic that the customer will want to come back to us in that period. But we are guiding at 11% below for the period through to the end of December, hopefully from a more cautious perspective. Recent consumer support, as I highlighted, has sort of been identified, which has certainly stabilised the impact of utilities pricing on the consumer. And now we wait to see what any mini budget as presented by government as to the impact that might have to encourage consumers to come out and spend. And then lastly, sort of from a revenue perspective, Robert has sort of indicated that we will continue with the development of the Barnsley and Durham stores, and both of those stores will open in the final quarter. With regards to the EBITDA margins, we do see continued pressure on food and beverage input costs. Contracts are in place for a number of the products, but there is threat of further price increases in the near term. We are optimistic, though, as we move forward into FY23, that this will then start to trend lower. To offset that, we have started, as I indicated earlier, with putting through price increases. These have been done in a very targeted manner, whereby we do take the time to consider every single item on a menu before we determine, so there's no sort of blanket price increases. And what we will be looking to do is to try and use price increases to mitigate the negative impacts of pricing. Utilities pricing does remain a challenge. Obviously, today we've had a further indication, which we will evaluate in terms of the benefits that the price cap that government is suggesting will have. At the time of this presentation, we were looking towards a utilities price increase in FY23 of some almost £6 million greater than what we were paying for in FY22. The substantial nature of the increase is partly down to the success we've had by hedging our pricing in September 20, which has had a very enduring positive effect. CapEx, maintenance CapEx at 1.75%. It's towards the top end of what we had guided previously. We also had guided previously sort of 1.25 to 1.75. This is very purposeful in terms of making sure that the state is in an appropriate position to benefit from any increases in demand, and equally also to make sure that downtime is minimized as best as possible. New site CapEx, we have recognized that there have been inflationary inputs in site developments. So what we have done is we've updated the numbers there. You'll see from, as a comparison back to previous presentations, that these numbers are not material. And what I will highlight here is that all of these numbers are prior to any landlord contributions, which you'll appreciate have been significant in the past and continue to be very meaningful in all our discussions with landlords. And then finally, in terms of store estate, on the right-hand side, we're taking a prudent view for the short term. We will complete the stores in FY22 as indicated. Our view thereafter is that we will seek not to open any new stores in FY23 in the first half of FY23, and that any new stores that will open will be towards the second half. That's basically from a perspective of prudence to ensure that we secure the business in the short term. But what we will also be doing is we will not discontinue our efforts to go out and find sites and contract them in such a manner that capital commitments or the actual expenditure of cash can be deferred until a time which is more appropriate from a more normalized economic trading environment perspective. And with that, if I could hand you back to Robert.
Thanks, Alan. So really, I want to start off by just again reiterating our 4D strategy, which we mentioned at float and also at year-end results. Our 4D strategy, which is dine in, delivery, digital, and drive to, remains in place and remains intact. On dine in, we're on track to deliver our medium-term targets of 100 Fridays restaurants and the 25 to 60,000 firsts. Just given what Alan said, however, we will be slowing down, certainly until we see some green shoots of some recovery in the UK, to not do any more other than the Barnsley and Durham stores, which open in in fact, Q4 of this year. We will not be looking to open any more until, as I say, we see some sort of recovery in the market to the second half of next year. That doesn't at all fracture or inhibit us to reach our obligation with the Americans, TGI Fridays in the US, in terms of our development agreement obligation, because we are ahead of that curve anyway to the 9 stores by the end of 24. And what will be a big influence for us in terms of new stores will be capital contribution. Will need to be significant, and it will be the key decision maker along with stores location and footfall numbers that we normally look at. And just to give you an indication, both Barnsley and Durham come with 7-figure capital contributions. So hence, these were the correct thing to go ahead with. On our second D of the 4D strategy, delivery, as we see, delivery is coming off its peak across the market, but remains an important channel to us, whilst we're not reliant upon it. We've always been pretty consistent in that view, given that the quality of revenue that delivery provides us with, given the aggregator costs, etc. We have, however, contracted and signed with Uber Eats, so we're now with the 3 main protagonists of aggregators in the UK in the delivery space. But again, we look back to what one of the larger ones mentioned in its recent release, that was 12% increase in Q1, which reduced to a 2% increase in Q2. So we do see delivery going backwards, and average order value has also gone backwards. So whilst we are in that market, we're not reliant on it, and I think we're in the right place given the business that we have and the style of food that we produce. On the digital side, we're fully now embedded with our CRM through Salesforce, so we're using a leading edge tool within the CRM space. Our EPOS system is in place across 3 of the 4 63rd and First as a test, which is order and pay at table, which is going down very well with the consumer. We'll also be trialling our new EPOS in Barnsley to replace our end-of-life system we have across the Fridays portfolio, and that trial will be from the outset of it opening in Q4. And then with our new CMO and that drive to a more data-rich environment, our omni-channel approach to data heading towards a single customer view is very much in our sights, and we look forward to that being fully embedded in the business over the coming months. And then lastly, our 4th D of Drive 2, our QSR concept, Fridays and Go in Dundee, is still in trial stage, opening in March. We've seen it trade at opening, we've seen it trade during the summer, and now as schools, colleges and football is back in town, we see it now stabilising back to the earlier levels. We're learning from this initial store to develop and improve the customer offering, its flexibility in pricing, its bundling and time of day. And we see that trial being enhanced by a foray into motorway and shopping mall as 2 other areas to really prove this project is going to have sustainability. On page 21, I just underpin the consumer research that we did with oyster catchers of 2019. These sit below the 4D strategy, where we will keep our prominence in quality, which is coming through in the guest scores of an NPS of 87% improvement, our relevance in the marketplace, and simplifying our product, which has enabled us to better execute dishes, and again, coming through in the NPS. And our 4D strategy, as I say, is underpinned by these 3 key pillars. In terms of focused approach to growth, we have mentioned as we launched HOSTMORE, our 3 elements there. Our organic growth of existing brands is the primary focus of our business, both Fridays and Go and 63rd and First. Our store expansion, fulfilling our medium-term objectives through site growth in attractive locations, using the typical measures of residential neighbourhoods, wealth per population, etc. And then also, whilst we still believe in exploring the acquisition of fledgling brands, we'd like to put a pause on that for the obvious reason of the economy, but also that we feel that what we have looked at has been overpriced in the marketplace. But our longer term ambition, and I stress longer term, is to acquire those smart, disruptive fledgling brands, leveraging off our back office, and that will only happen when the trading environment stabilizes. I can move on to page 23, a pleasing page to read, all around improving the customer ratings. Improvement across our guest KPIs, particularly around value and food quality, reflecting our investment in both the product and the overall proposition. The positive customer satisfaction across the period is reflected in Fridays. The Net Promoter Score, NPS, up by 87% to 43 at September 22 from June 22, driven by improvements across multiple areas: food, drink, service, speed of service, atmosphere, cleanliness and value. And then our guest opinion score, which is the aggregated score of NPS, which makes about 80% of that score, the rest being real-time data from the likes of Google and of TripAdvisor, sees the overall score grow from 68 to 70. But again, I emphasize the food quality improvement that we've seen and the value improvement we've seen are the key drivers for our overall customer rating, which in the long term can only be good for the business. On page 24, we emphasize here our renewed approach to marketing under the leadership of Rhiannon and Scarlett. Again, reiterating there, coming from a retail background, not a casual dining background, and from a very data-rich environment, having been some length of time at Dunnhumby. So first of all, brand awareness remains strong at 70% of UK consumers. This is endorsed by the CGA data. But competition for spend is fierce in a very, very difficult environment. So launching a digital first media campaign in the first week of October, the name Showing Your Stripes, in a nod to the red and white stripes that our brand is so known for in its heritage, leading on trends of inclusivity and liberation and showcasing our bar experience as an aspirational destination. Our bar experience, obviously the core to why Fridays was formed in the first place. The next two pillars talk about the female audience that we're aiming to reach out. Again, that came loud and clear from our consumer research by Oyster Catchers in 2019, nearly 20. So our first influencer brand ambassador, Fern McCann, is now on board, known on reality TV, and we've done a bit of work with her and her daughter around engagement in the stores and around social media. And then our focus and our approach to women's football and our partnership with the WSL and teams across that environment to reach out to that female audience and seeing Fridays as a place to come. And then finally, location, words from my CMO, more focused local approach to pay per click to drive bookings and profitability in optimal locations. Rather than a blanket approach, we're targeting a local approach to how we spend our marketing dollars in the digital space. On page 25, again, something we'd like to cheer about is our Green Mission initiative. And that was a snapshot about how we can manage our energy in-house. We introduced 3 campaigns. So a Safe While You Sleep campaign, turning off equipment that does not need to be left on overnight in store. A perfect setup, ensuring equipment is only turned on as and when it's required, rather than firing up the whole kitchen first thing when the chefs come into work. And trading slow, keep it low, turning off equipment that is not being used in slower periods. That's resulted in a 12% consumer saving, £560,000 and a 704 total carbon savings, with 3.7 million of kilowatt less electricity being used. And that's ongoing. They're numbers that are hot off the press and will only but grow, given the initiative has been well received and adopted by each and every store. So what's the current trading and the outlook? So the current trading reflects the enduring impact of a weaker consumer demand due to the pressures of cost of living that we're enduring in the UK at the moment, which has been materially offset by us mitigating costs and saving initiatives around all parts of the business, and is continuing. Our 2 Fridays openings in the second half of full year 22 and discussions ongoing for further store openings across 63rd and 1st Fridays and Fridays and Go, as described, will be entertained, given that we are offered the right level of capital contribution and the deal being absolutely right. And as Alan said, in a way that we can defer any capital being utilised while still securing the actual deal itself. We remain mindful of the wider pressures on the consumer and how this may impact leisure spend going forward, as well as ongoing challenges in the operating environment. We will retain our strong focus on mitigation to limit the impact on margins and on the execution of our strategy. Thankfully, our balance sheet strength and increased headroom post the refinancing provide us with increased flexibility for expansion and some sort of safety net. At that point, I'd like to open the floor to any questions, and I see they are now coming through on the panel.
Yeah, they certainly are. Robert, Alan, thank you very much indeed for updating investors. Could I please ask investors to continue to submit your questions using the Q&A tab just on the right-hand corner of your screen. Just while Robert and Alan take a couple of moments just to review the questions that you've submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the Q&A, can be accessed via your dashboard. Robert, Alan, if I may ask you just to open up the Q&A tab, and if I could ask you, where appropriate, of course, to read out the questions and give a response where it's appropriate to do so, and then I'll pick up from you at the end.
Yes, good morning, Georgie. I think that's Georgie G from MGA. I only received the news from the announcement in between our own webinar and this webinar, so I would like some time to absorb what the government's offering, and I'll come back to you directly on that one, if you don't mind, once we've had a good look at what the impact is. The headline is we see it's benefiting for the next 6 months. We obviously have significant hedging in between now and the end of the year, so let me have a proper look at what that looks like and come back to you independently, if that's okay.
I just need to read out the question.
Yeah, Stephen K, you've asked, Fridays and Go sounds an exciting concept. What's the plans to roll out there? What are the setup costs for these stores? Well, it is an exciting concept for us. As I said, we've trialled a city centre downtown version of it in Dundee, and we saw a very strong start, a bit of a lull in the summer as universities and schools and football in that particular city closed down for the period. Since it's came back again, we're beginning to see that now giving us the numbers we want. It's a trial. We're learning a lot from that around time of day, about bundling, about pricing, etc. So yeah, very excited about it. We feel in order to really flesh out the trial, we need to try it in a motorway service station environment, potentially a shopping mall environment, which we are keen to do and under negotiations of some sites to do that. And the setup costs here for these stores are materially less than, I call it our capital light model, and materially less than a fully blown store. And I think Alan has shown you some of those numbers earlier in the process. But we do see this, as do many, as a game changer and a great place for us to fill the gaps. Whilst we've got good geographic spread in the UK, a lot of white space that we still need to be into. And that's what we really see this as a growth brand on the go forward. Simon B, you've asked or said that the HOSTMORE shares seem to be trading significantly below the intrinsic value. What do you think explains the poor share price since IPO? Would you consider share buybacks given the low share price? Will the near-term headwinds, energy prices and potentially lower consumer demand affect your plans for Fridays and Go? Alan, do you want to take the first bit?
Yeah, I think in terms of the shares, certainly we believe that the shares are undervalued, but I guess many would say that was a natural bias. But I think if you could compare back to FY19, where we were generating on a pre-IFRS basis EBITDA in the region of £25 million a year, it just doesn't seem to make a whole bunch of sense as to why the market is quite so pessimistic about us. Now, some of that in terms of the guidance that we're receiving from brokers and various other parties may be down to the share register that we inherited upon listing. Now that we have seen some change that's taken place over the course of the first half of the year, where one or two of the larger shareholders, which are not traditional long-term holders of direct investment retail sector companies, have exited, and we're pleased with the parties that have come back in and taken their place. I think with time, like anything, we just need to show evidence that this is a good, strong, well-managed company. And as I say, I refer you back to FY19 as the guide. I think what's been happening over the course of the last 2 or 3 years has been unsettling, and I don't think it's a true reflection of the potential as we go forward. In terms of the buybacks, it is something that we've considered. We've limited buybacks through the Employee Benefit Trust, where you would have seen an announcement that's gone out previously, whereby a small section of shares were acquired in order to sort of fulfill obligations of the company on the go forward. Larger scale share buybacks, we think is possibly not prudent just in the near term, simply by nature of the uncertainty of the trading times that we're in. There's no doubt that as we move forward, we would look for various means of appropriately distributing funds back to shareholders, either by way of dividend, share buybacks, or some alternate form.
And I think the last part of that question, will the near-term headwinds, energy price, potentially lower consumer demand, affect your plans for 63rd and 1st and Fridays and Go? I think we've answered that through the course of the presentation. On Tim K, you asked the questions. You make a lot of claims about improving guest scores. However, a look on TripAdvisor shows some very poor results, e.g. Harley, you've got 2713, 29 terrible reviews. How we have the honest assessment. You have got the honest assessment because that only contributes about 15% of our total feedback. Majority of our feedback comes in form at store level and through our own channel, and therefore that's why the NPS result is so high. The guest opinion score, which includes TripAdvisor, is still an improvement, and that's because we've got over 71 stores of the 86 that are above 4 and above. There are some stores, admittedly, that we still need to get right, and that's down to local management, of which we are constantly on to improve. But the assessment that we give you in the 87% is a true fact, and it makes 85% of our total feedback, of which the point you're making is a smaller percentage. Okay, next one. With fledgling restaurant brands overpriced and HOSTMORE trading at low multiple, I think we've covered that one. Alex L, can you provide further colour on how 63rd is going operationally? Is it meeting expectations, and do you see the rollout accelerating to come in a better economic environment? It's too early to tell. I think it's not too early to tell. I think the mature stores, the Cobhams and the Glasgows are now trading at very strong levels. Glasgow particularly, when face masks came off in Scotland and we rebooted the actual business through a PR campaign, we're now seeing great numbers in Glasgow. Edinburgh's brand new, although and opened during the festival, so obviously did very well over that period. It'll settle into its own shoes now, and let's see where that takes us. Harrogate has been a disappointment, difficult environment. We're told that chain restaurants in Harrogate has always been difficult, but we'll keep going there. But overall, operationally and in terms of food execution and the NPS and the TripAdvisor scores are particularly high there versus Fridays. So I think we've got it operationally correct. It just is a time of bedding down. But equally, to your point on expansion, we still believe in it. We still believe we can get to 25 stores. We said it'll all come down to the right deal as we go forward in the right location.
If I can pick up this one, Peter C, you asked the question on the impairment of leases, how many sites are involved? Is it a few big sites or many small ones? And what is your confidence in being able to return the provision over time? You're absolutely right. There's approximately 20 stores that were affected on this occasion. But of the 17.8 million value that we make reference to, about 50% of it is attributed to 3 stores. Those 3 stores are either stadium locations or city centre locations, whereby the view is that they will return. When I say the city centre, it's a non-London store, which has traditionally traded very well. At the beginning of this year, we did have a bit of a change of management there because we felt it wasn't trading adequately. So, more recent trading gives me a great deal of comfort that it will revert. The view is very much one, as I sit here at this moment in time, as we exit recessionary times, I think there's a high probability that a substantial amount of that value will be reversed. Lost your name here. Just come back.
Mark S, you ask, is Fridays is expensive compared to other restaurants in my local area? Is the premium pricing a risk in a cost of living crisis? Actually, interestingly, whilst volumes have been down, spend has been up. Fridays is very much seen as a destination, high value occasion destination, and therefore, we are comfortable that, and particularly given the value scores we're getting from the majority of our feedback, we are pretty comfortable that we're priced in the right place, and certainly not getting any adverse feedback from guests on that particular subject.
Okay. If I can answer, Tim K, you asked if we agree that shares are very good value, why are the directors not buying? I think if you go back and look at the RNS announcements that have gone out, you will see that a number of directors have actually bought. And I'm pleased to say that I am one of those buyers. Rupert K, you asked how negative would like-for-likes need to get before the group turn cash negative pre-new store capex. I think there's still some way to go. I think what we have got in place is very much a program whereby, dependent upon how trading were to change, there are various actions that we would take in order to mitigate against that. So it really depends on the significance and the severity of. But I think the actions in terms of cost mitigation that we would seek to introduce if revenues were to continue falling would go some way and provides a fair amount of headroom.
David S. You say some of our actions, like more targeted digital, social media, and cutting unnecessary energy usage, seems obvious. Why only doing that now? I think we've been doing that for some time. Certainly since we came here, our digital and social media spend has been differently targeted and differently spent. The green mission is all part of our ESG, which was first announced when we launched a year ago. So this has been in play for some 12 to 15 months. I think I hope that answers your question.
Thanks. That's the last of the questions which I have up.
That's great. I appreciate both Robert and Alan, and thank you to everybody for your questions this morning. Robert, Alan, I know investor feedback is particularly important to you, and I'll shortly redirect investors on the call to give you their thoughts and expectations. But I wondered, before doing so, if I may, Robert, just ask you for a few closing comments.
Yeah, thank you. Firstly, thank you for all joining the webinar this morning. It's great to be able to share some more detail around our interim results. I think we all know we're in a very difficult trading environment, and there is definitely a squeeze on the consumer. As I said, Georgie, I'd like to understand a little bit more as we absorb what the government has said today, and hopefully there's more to come in terms of supporting Kate Nichols from UK Hospitality. We certainly have joined in participating in the plea to government to look at VAT and business rates. But I think with the difficulty in trading and as we've described it, we are laser focused on making sure that where we can control costs with our Win Our Gift, we are doing that. And I think hopefully we've demonstrated today that we're controlling the business whilst in this lull, and also shown prudency in terms of our capital rollout. But again, thank you very much for your time this morning, and I wish you a good day.
That's great. Robert, Alan, thank you once again for updating investors. Can I please ask investors not to close this session, as we now automatically redirect you for the opportunity to provide your feedback in order the management team can better understand your views and expectations. It'll only take a few moments to complete, but I'm sure it'll be greatly valued by the company. On behalf of the management team of HOSTMORE PLC, we'd like to thank you for attending today's presentation. I wish you all a very pleasant morning.